Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Canadian investors, you love your GICs. Canadians have $500 billion invested in guaranteed investment certificates. For context, that's about the same size as the Canadian ETF industry. Higher interest rates a few years back attracted a lot of investors who were earning around 5% or even higher on GICs at the time for virtually a risk-free investment. Not bad. But with interest rates cooling and investors looking for maybe a little more flexibility, they're asking themselves, are there other options that exist for my cash sleeve? And that's a really good question. I'm Danielle Nezel, VP of Online Distribution at BMO ETFs. We have Matt Montemaro here with us today as well. He's the head of fixed income and equity index ETFs at BMO. We're going to break down some of these cash-like investment products that are available to investors so you have all the information you need to optimize your cash sleeve. Reminder today, Matt and I were not giving you any investment advice or investment recommendations. Today's show is all about investment education for Canadian do-it-yourself investors. Matt, thanks so much for taking the time to come on the show today.
Thanks, Neil. Looking forward to the conversation.
So let's start at the beginning. What is a GIC and why have they been so popular among Canadian investors?
So a GIC, from textbook definition, is a guaranteed investment certificate. It is a low-risk investment product offered by Canadian financial institutions that guarantees the return of your principal plus interest over a set period or set term. Terms can be as short as 30 days, as long as, in some cases, 10 years. But in general, we find that most GIC offerings, the most common GICs used by investors, range between 1 and 5 years. Most GICs have a fixed term and can be either redeemable or non-redeemable, so cashable or non-cashable. All GICs are CDIC insured up to $100,000. So let's go into the different kinds of GICs here. So a cashable GIC tends to pay a little bit of a lower yield, and that compensates you for the flexibility or the ability to redeem whenever you want. You pay for the flexibility to get your money whenever you want. This is not the most common type of GIC, though. The most common type of GIC we see is that non-cashable, non-redeemable GIC. So that means once you lock it in, you have to keep it there until maturity. So most GICs will pay a near market yield. So potentially, it's around that overnight rate. Some GICs will pay a premium yield, a special yield, a yield that is higher than that overnight rate. And for this commitment, investors are guaranteed their principal and interest back as long as they hold it all the way to the end of that fixed term. So GICs have always been an attractive tool for many investors. Investors in Canada specifically tend to be a little bit more conservative, and they view it as a low risk, almost no risk investment. And in recent years, we have seen a wave of flows move into GICs. In 2022, as we saw rates rise, the yield curve inverted, meaning that some GICs were paying 5 to 6% yields. No risk for outside of liquidity risk, but no risk for 5 to 6% yield. It was a winning trade for many, many investors. We saw record flows into GICs in 2022, 2023, 2024. And while that has started to slow down in 2025, as we've seen interest rates come down, it has yet to reverse completely. So with that said, as rates went from 6% to 2.5%, you can imagine investors are going to have to start making some tough choices. And many are predicting that there's going to be, at this next maturity window, there's going to be a lot of investors looking for where they can put their money, where they can park their money, now that they're not getting those yields of 4, 5, 6% that they were used to when they locked in 4 or 5 years ago.
So as yields are dropping, is there an update on where GIC yields, or what are their rates today compared to what they were 3 years ago?
Yeah, so again, generally will follow the path of the overnight rate. So if you think of the overnight rate at one point was in and around 5%, we're at 2.25% now. So generally for GICs, you see it slightly above in and around that overnight rate. So if you look at a big six bank, for example, you can generally expect about plus or minus 25 basis points of the overnight rate for a 1 year non redeemable GIC. If you go and you look at some smaller institutions, some credit unions, for example, you likely can take a little bit more yield. They offer a little bit more of a premium yield for what many view as a little bit more of a credit risk component, given they're smaller than the big six banks overall. But if you look at the trend, I think the GIC phenomenon overall, like that cash is king era, it was a real thing. We saw flows continue to flow into these short-term investments. The front end of the yield curve was extremely attractive for investors. However, I think that's starting to change. I think a lot of investors can meet their income needs with 3, 4, 5%, but at 2.25 or 2%, a lot of investors are going to have to say, okay, are there other areas where I can invest? Is there another part of the curve that I can look to? Should I be looking at dividend paying stocks, for example? It's a different risk profile, but I think a lot of investors who were moving into GICs weren't naturally just a fixed income investor, but it was an investor looking to maximize the value of their cash. So that's something to consider. And then finally, your original question was on, where do these rates derive from? In general, GIC rates are, in and around that overnight rate, but it's important to understand that every bank will price their GICs uniquely. And so if a bank wants capital or wants deposits, they may incentivize that by increasing their yields on their GICs. So while GICs are somewhat linked to market rates, so you will see as the overnight rate went down, GIC rates went down as well. In many cases, they can also be linked to the strategic priorities of banks or the financial institutions, whether they need capital, want capital, or whether they're maybe flush with capital, so maybe don't need to pay such a premium. So those are things to consider when you're looking at GICs, and don't be surprised that one bank versus another may have a rate differential of could be 50 basis points in some cases.
You make a few great points there, and I do want to add, when you're thinking about these cash like products, investors, what you're really doing is maintaining that purchasing power of your cash, because you got to think about inflation in the equation as well. And right now, we're looking at rates pretty close to where inflation is. So if you're reinvesting in GICs or cash like investment options around that inflation rate, you're not growing your money, but you are protecting its purchasing power. You talk a little bit, Matt, about redeemable versus non-redeemable GICs. This is a very big differentiator for someone looking into a GIC, because a lot of cash investors, they don't know exactly when they want their cash. They might need it for a rainy day fund. They might need it to purchase a house, but they're unsure of the timeline of when that property will be available or come to market. So for investors who want that liquidity, that cash pretty much gives investors that flexibility, what are options outside of GICs that they can look at?
Yeah, so ETFs have regularly become a common substitute for GICs. Especially in volatile markets like we're in right now, investors can grow concerned about locking their money in for long periods of time. Like as you just said, you don't necessarily know when you're going to buy that house or when you're going to need that purchase. So locking something in for 2, 3, 4, 5 years, your financial picture can be very different in 12, 18, 24 months from now. So that's where ETFs have come in. And we've seen a lot of investors and a lot of traditional GIC buyers for that matter look to ETFs, something like ZMMK or BMO Money Market ETF for Canadian exposure, or ZUCM.U for US dollar exposure to generate a similar, if not slightly higher yield without the challenges of a lockup period. So, in periods of stability, I can see where investors say, feel more comfortable. I'm going to lock it in. You know, nothing's going to change on the horizon. But especially during periods of volatility, we do see investors grow more concerned and about locking that locking their money away and having access to that capital if and when they need it. If we move into a recession and need to dip into that savings, using something like an ETF provides you that flexibility you may need, where a GIC unfortunately does not. In terms of what's the difference in terms of the investment, ZMMK invests in low risk fixed income instruments like T bills, federal, provincial, and corporate bonds. We generate attractive yield, but there's very little downside risk. We're buying bonds that are very short term. Their term to maturity is in and around 40 days. So the likelihood of any sort of default or downgrade risk is extremely low, if not near zero. So when you're looking at it, you're getting that same protection, albeit you're not getting that guarantee. However, when you're comparing the trade-off between a ZMMK and a GIC, the trade-off is essentially, do you want liquidity or do you want that guarantee? I would say a lot of investors in volatile markets will opt for liquidity because the rates are very, very similar and competitive, and that added flexibility tends to give you some comfort when you don't know what's to come.
Now, you talked a little bit earlier about now that rates have come down, investors might want to think about stepping up the risk spectrum a little bit and or more depending on the risk tolerance or risk profile. But when we're talking about GICs and money market funds, we're really talking about as low as you can go in the risk spectrum. So let's talk about stepping up just a step. What options are available for investors that keep things pretty low risk but can maybe pick up a little more yield?
Yeah, so another option for investors who might want that little bit more yield, they want to maximize, it is a cash sleeve and you want to maximize the yield in that cash sleeve, would be to look at ultra short-term bond offerings. So again, very, very similar to what ZMMK would invest in, except a little bit more higher risk because it's more corporate exposure. So for example, for Canadian exposure for us, we offer ZST, our BMO Ultra Short-Term Bond Fund, or for US dollar exposure, ZUS.U, so our BMO US Ultra Short Term Bond Fund. Both funds invest primarily in high quality corporate bonds. So 100% investment grade exposure. All bonds will mature within a year. By focusing the portfolio on corporate bonds, what we're able to do is extract a yield premium to both money market and the overnight rate. So, investors who are willing to take a little bit more risk, again, you're moving from maybe governments to corporate exposure. They're able to capitalize on 10 to 25 basis points of extra yield by targeting that corporate bond exposure. There's a trade-off here. You're trading, I guess, yield for downside protection. But again, ZST, because we target high quality issuers, because all these bonds mature within a year, we're actively monitoring those issuer rates to ensure that we are maximizing downside protection and maximizing yield. So that's where I think ZST fits in a lot of portfolios. And if you look over the last uh, 2, 3 years, ZST has been one of our fastest growing ETFs because a lot of investors say, you know what, it's only a little bit more risk. It's a little bit up higher, the credit curve, but I'm getting that additional 10 to 25 basis points of yield. That's a worthy trade off for me. Ultimately, I think it is still a portfolio that is focused on downside protection, but maximizing yield while doing it.
Now, to be clear, all these products we're discussing today are fixed income products. And investors who are investing in fixed income products need to consider which accounts these products are in because their distributions are income. Matt, what can you tell us about these types of products in taxable accounts and what options are available in on the fixed income spectrum that might be a little more tax efficient for those taxable accounts?
Yeah, so I'll preface it by saying we aren't tax experts, but it is always good to understand the implications of your investment decisions, especially if you're investing in taxable accounts. So fixed income, as you said, tends to be a little bit more punitive in terms of taxation versus equity market or stock investments. This because coupon earned in fixed income is taxed as income, where Capital gains or growth in your equity part of your portfolio is taxed as capital gains at a lower rate. So, therefore, when you are investing in bonds, fixed income ETFs, or GICs or money market, it's always good to understand the tax implications that you're making, along with some of the other things like diversification, liquidity, yield. So, for products we've discussed today, for taxable investors, a GIC or a money market, they'll have the same taxable impact. So that's going to be taxed 100% as income. So for these funds, the coupon earned is equal to the posted yield to maturity or expected return. So whatever you earn there, expect that that's going to be taxed as income at the end of the year. This, however, is not always the case for all fixed income. So, for example, in strategies like ZST, as we discussed, or our discount bond suite of products, so ZDB, our BMO discount bond fund, ZSDB, ZCDB, we actively target bonds with lower coupons. So what we aim to do is we aim to enhance the tax efficiency of that exposure. So by targeting lower coupon bonds, yet maintaining similar risk characteristics, so a similar yield to maturity, a similar duration, similar sector weights, issuer weights, what we're able to do is the client will actually earn a lower percentage of their return via coupon versus capital gains. So what that does is it reduces the income earned within the portfolio, hereby lowering your overall tax impact. So for taxable investors, it's very important to understand these implications. So in many cases, there are discount bond versions of broad exposure. So for example, ZDB is the Canadian bond universe. So if you're a taxable investor, you should consider ZDB as a more tax efficient exposure for that similar broad bond universe. ZSDB, our short-term Canadian bond, would be the more tax-efficient equivalent for the short-term bond universe. And finally, ZCDB is our BMO corporate discount bond, which should be the more tax-efficient version of the Canadian corporate bond universe. So again, similar exposure to the broad market, but provides it in a more tax-efficient way. It doesn't eliminate taxes, it just reduces the amount of coupon versus capital gains in your overall return stream. So if you are an investor that is considering short-term instruments for that cash sleeve, whether it's money market, short-term fixed income, GICs, make sure you consider yield, liquidity, risk tolerance, and the taxable impact when you're making that choice. Because ultimately, if you are trying to generate the maximum yield available in this cash sleeve, and it's in a taxable account, you want to minimize that impact that you have to send, over to and pay in taxes. Because net, after taxes is going to be your actual return, what you end up in your pocket. So, the discount bond suite, something like ZST, is actually very, very well positioned. And we regularly see investors use the regular broad beta for their registered accounts, and they'll use the discount bond suite for their taxable accounts. Because again, it's very similar exposure, except you are minimizing your taxability.
So many great points there. And for anyone investing in fixed income or cash like products, always remember your yield or your return is pre-tax, and it's also pre-inflation as well. So when you factor in inflation and tax and you look at that real return, it could be a lot less than what's advertised. So lots of great things to think about. Matt, thank you so much for coming on the show and talking us through GICs and other cash like products.
Thanks, Neil. Really enjoyed it.
That's it for us on ETF Market Insights this week. We'll see you next week.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.